Well, hi guys, welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. Well, it's a tepid Tuesday, in fact subdued Tuesday, so to say, given the fact that the global markets are giving out subdued cues. In fact, Wall Street saw, the Dow saw a sixth straight session of weakness, and of course the GIFT Nifty hinting at a near 200-point cut on the Nifty once again. So yesterday we slipped below that 22,300 mark. Today as well, 22,200 mark will be crucial to watch. Although we have slipped below that 20-day, exponential moving average on the Nifty. Key support level has been broken, but of course 22,200 will be a very, crucial level to watch out for on the index. But of course, lots lined up over the next 40 minutes. We'll be talking about all the stocks in focus. We'll be taking up all your stock-related queries as well with our experts on the show. So if you have any queries, keep them coming in on our live feed on YouTube and we'll try and take them up. But before we move any further, let's quickly take a look at the top stories at this hour. Weakness persists on Wall Street with the Dow logging losses for the sixth straight session. US 10-year yield jumps to its highest level since November. Meanwhile, shares of Tesla also slump as the company announces that it will lay off up to 10% of its workforce. In key earnings, Goldman Sachs beats estimates and the stock was up and about in a weak market. Asian markets open with deep cuts. Israel says it will respond to Iran's missile and drone attack, even as US and other allies assert that they will not be involved in any retaliation on Iran. Meanwhile, China Q1 GDP beats estimate. The GIFT Nifty, however, suggesting a drop below the crucial support level of 22,200 mark. Gold prices rise on safe haven buying while silver hits a 3-year high on industrial demand. In fact, Brent crude remains range bound around that $90 a barrel mark as geopolitical situation in West Asia remains uncertain. Day after releasing the BJP's election manifesto, PM Modi expresses his vision for a developed India by 2047. In an interview to ANI, he says he has big plans for the country and that his decisions are not made to scare anyone or to diminish anyone. PM Modi also reveals that he has already set a target plan for his first 100 days in office if he is elected to the next term. Well, we have just about 12 minutes to go for market open, but let's see what the cues are looking like. If you look at the Nifty spot, it closed below that 22,300 mark, down nearly 250 points. The Sensex as well shaved off nearly 850 points to shut shop below that 73,400 mark as well. India VIX, that shot up over 8% to come back around that 12.5 level. And if you look at the Nifty Bank Index, that snapped out of a 6-day gaining streak, down 790 points, below that 48,000 level, which was being pegged as a crucial support for the index. In terms of, F&O cues, if you look at the April series, the open interest on the Nifty was up 6.8%, added somewhere around 7.3 lakh shares. April futures are trading at an 84.8 point premium vis-a-vis a premium of 82.05 in the previous session. And if you look at the Nifty Bank Index, the open interest there was down 5.3%. It shed somewhere around 1 lakh shares. The Nifty put call ratio came down to 0.81 vis-a-vis 0.87 in the previous session, and as many as 11 stocks are in the F&O ban today. The new entrants are Bandhan Bank, Exide and SAIL, and the stocks that continue to be in ban are GNFC, Metropolis, Piramal Enterprises, Balrampur Chini, Nalco, Hindustan Copper, India Cements as well as Z. Vodafone Idea is one counter that has come out of the ban. Remember, the FPO will be opening on the 18th of this month, which is on Thursday. And of course, you can log on to moneycontrol.com and see what experts have to say on whether or not you should be subscribing to that FPO. Let's take a look at the fund action. FIIs remain net sellers. In fact, they have turned net sellers for the month of April as well. Yesterday, in fact, there was net outflow to the tune of 3,200 crore rupees in the cash market. But DII buying support remains. DIIs were buyers to the tune of 4,700 crore worth of stocks in the cash market. But let's get on board our technical expert for today, Aamar Deo Singh, joining in. Of course, he is the Senior Vice President at Angel One. Thanks a lot for joining in, Aamar. Looking at the texture of the market, it's not a pretty picture this morning. GIFT Nifty was also down somewhere around 200 points at one point. Do you think the crucial support level of 22,200 will be taken out? And for the Nifty Bank Index also, are the charts signaling further pain?
Yeah, very good morning, and thank you for having me on the show. So, see, markets, the way the markets have corrected over the last couple of days. So that clearly shows that there is some concern definitely with regard to what's happening or unfolding in the Middle East, because till such time, because we have the Russia-Ukraine war, which is continuing. No one really talks about it. If you look at Middle East, so the way Israel has gone out in the Gaza Strip, so that also was the markets had factored in. But the strike that Israel means the strike that it had on the 1st of April for the Iranian embassy, that really, I would say, again brought spotlight into this area. And Iran's attack on Israel was the first of its kind. So that really unnerved the markets. But the markets, to a certain extent, have factored in that this could be managed by the US and its allies, that it doesn't really blow up significantly. So that the markets are, to a certain extent, expecting. But again, some worries there on the crude oil front, because if you look at the crude oil data in terms of Brent crude, it's trading about $90. So if that sustains over the $90, then there is this inflationary trend fears which is there, and also the rate cut which markets and investors were anticipating from the US Federal Reserve to happen. That also doesn't seem like. Now, coming to the levels, as you rightly said, 22,200, 300 band, that's a very strong support zone for Nifty. Because if that is taken out, then we could see Nifty headed lower towards 22,000 levels, because that would be the next level of support for Nifty. And if you look at the derivatives data also, that also clearly shows that there is a lot of call writing which is happening, and that is clearly reflected in the charts. If you look at the futures data, that also shows that a lot of short build-up has happened. Now, talking about I would say Bank Nifty, again, Bank Nifty has corrected from the highs, recent highs. So from almost 49,000 levels, currently is on 47,400. If we go back and see, so somewhere around 46,700, 800, so almost 700-800 points below, Bank Nifty has got very strong support. So the way, if you look at the charts from a long-term perspective, the trend is up, but the momentum definitely has come off. So we'll have to watch out for these levels. The first trigger is 22,200. I believe that could be taken out today. Then the next level for support for Nifty is around 21,950 to 22,000 level. But the way the markets are correcting, we could see some further sell-off happening as well. And also the advanced decline ratio also is not very positive to say.
Well, that's correct. Of course, we've also seen a spike in volatility. But talking about, particular stocks that will be in focus, ONGC, first of all, yesterday it was holding up in a weak market. We saw a 5% gain coming in. Of course, then there was a news flow, in the late night that came out that government has hiked the windfall tax on crude output to 9,600 rupees, from 6,800. Of course, this is a negative for upstream companies like ONGC and Oil India. Today, would you see, a sell on rise kind of a scenario playing out, given the fact that yesterday was the stock was among the top gainers? So could it see some bit of pain today?
See, a couple of things. One is that when the overall market sentiments are weak, then if some stock really outperforms, that means there is something inherently positive and strong in the stock. One. Secondly, if you look at the levels for, I would say, ONGC, that it had made a high on 6th of March of around 284 levels. Currently, it's around 277 odd. So that would act as an immediate resistance zone. And as you said, that the government's hiking of windfall tax, that could have some impact. But overall, I would say ONGC is still positive and strong on the charts. But I will have to watch out for these levels. On the downside, support for ONGC somewhere around 260 to 285. That's a zone of ONGC with a positive bias though.
All right, that's about ONGC. But Jio Financial in focus, right? It has announced a 50-50 JV with BlackRock for wealth management and broking business. Of course, back in July 2023, the company had announced setting up of a JV with BlackRock for its AMC business. Of course, it is awaiting, SEBI nod for the mutual fund license. But, on the charts, how are you viewing Jio Financial? I think yesterday the stock was down somewhere around 4% or thereabouts. But, Jio Financial, how is it looking on the charts? Although it is a recent, it is a recent listing, so to say. But any signals coming out of, the charts right now?
So if you look at the charts, Jio Financial continues to remain strong on the charts on the intermediate term trend, because long term we don't really have that much of data to extrapolate. Having said that, if you look at Jio Financials, on 12th of March, it had made a high of 374, and then it hit a low of 318. Currently, it's around 364, 365 odd level. So it had then again made a high of 378 recently, as recent as 8th April. So what that tells me is that the stock is trying to inch up higher, but somewhere or the other, 380 levels is a level of resistance for the stock. But the intermediate term trend for the stock remains very strong, because we have at least that much of data which talks about or shows us how the intermediate term trend is, and there is no loss of momentum. So what it effectively means is that any pullback in the stock is a buying opportunity somewhere around. Now the stock has got, Jio Finance has got very strong support coming around 340 levels. Whereas on the upside, the resistance, immediate resistance is 380. Taking that out, sustaining over that level, it would be again trading at all-time highs, and then that could mean that the stock could further rally towards 420, 425 odd levels. But the levels to watch out immediately is 340 on the downside and 380 on the upside.
All right, those are the levels to watch out for on Jio Financial. But VST Industries, this stock will be in focus because ace investor R.K. Damani has bought additional 1.5% stake in the company for a little over 3,689 rupees per share. But HDFC MF mutual fund, on the other hand, has sold 1.3% stake. But VST Industries has been in a steady uptrend. Here on, it's 3,775 is where it's perched at the current juncture, but it's still some time away from its 52-week highs. Do you expect the uptrend to sustain going forward?
See, if we look at VST definitely is positive on the charts. There's no doubt about it. But if you look at it from a long-term perspective, and I'm talking about the long-term perspective, I'm referring to at least 8 to 10 quarters. So that clearly tells me that the stock is in a consolidation zone. So with a positive bias, no doubt, because if we go back in time, the stock in the first week of January had made a high of almost 4,300 levels, and then as recent as the second week of March, the stock had made a high of almost 3,850, 3,860 levels. So what it tells me is that, and if you look at 3 days prior on 12th of April, the stock witnessed significant volumes and delivery quantity. So that tells me that there is, and that day the stock had closed strongly. So the levels to watch out for, immediate levels to watch out for the stock is 3850, 3860. If that is taken out, the stock sustains over that level, then the stock is likely to head towards its earlier highs of 43,000, 4,300 levels. So the stock definitely has a positive bias and continues to remain strong.
Now, on the contrary, Cipla is one stock that has seen some bit of pressure. In the last 1 month, we've seen 7% being shaved off. This morning, the stock is in focus. It has made, an acquisition, so to say. It has bought IVR Beauty's cosmetics and personal care business for 130 crore rupees. But given the kind of, signals that we've seen on the stock over the last 1 month, do you see some bit of, weakness to persist here on? Or do you think there could be some bit of buying at lower levels?
So this is which stock you wanted to talk about?
Cipla.
Okay, Cipla. So if I look at Cipla, see, pharma, what we are seeing is that we are seeing some sort of consolidation happening in the pharma space, because most of the pharma stocks are witnessing profit booking happening. Now, looking at Cipla, we saw the stock witness a spectacular rally. If we go back and see, so from almost a year back, when the stock was around 900 levels, and from there it traversed all the way towards 1500 levels. So that was a significant rally. Currently, it's around 1385. The long-term trend remains strong and positive for the stock. So any pullback in the stock towards, if you ask me the levels, so the levels would be around 1300, 1350. That's a very strong support zone for the stock. So anywhere between that level can be a buying opportunity with an upside potential of around 1450, 1470 on the upside. So one needs to remember that though the long-term trend for Cipla remains positive, we are seeing some weakness in the intermediate and the short-term trend. So effectively, it means that the stock could correct further towards these levels. So 1300, 1350 is the level to watch out for. That could be a level for accumulation. But again, on the upside, seems to be capped around the 1450, 1470 zone.
All right, 1450, 1470 upside, levels will be capped for Cipla on those levels. But hold that thought, markets have opened. Of course, it is a weak open as was being expected. Another 160-point cut on the Nifty. It's, of course, below that 22,200 mark, in fact even below that 22,150 mark as we speak. 500-point cut on the Sensex as well, below that 73,000 level now. And mid and small cap indices moving in tandem with benchmarks. If you look at the mid cap index, down 0.6%, sectorally as well. The Nifty Bank Index has shed another 400 points, so it's below 47,500 mark as well. Almost a percent kind of a cut coming in on the Nifty Bank Index as well. Let's also take a look at the metal index. Let's see what the metal index is doing, given the fact that the China Q1 GDP estimates were above estimates, I beg your pardon, but industrial production as well as retail sales were below estimates. Of course, weakness on the metal pack as well, 0.5% down. The IT pack, 1.5%, almost 1.2% kind of a cut coming in on the IT index as well. Yesterday as well, it was among the top laggards sectorally. But most of the sectors are trading in the red. Pharma marginally in the red, but it's across the board weakness today as well, as was being expected, and the kind of signals that we saw coming in from the global markets. FMCG pack, of course, IMD has predicted an above normal monsoon for the current year, so the losses are pretty much tempered on the FMCG pack. But of course, the texture of the market, of course, looking very weak, not a pretty picture. It's a sea of red across the screen. Even the advanced decline ratio, it's almost right now, of course, 1:2. That is the advanced decline ratio on the NSE. So breadth remains weak. Let's take a look at some of the movers and shakers on the indices. On the Nifty, the top losers are NTPC, TCS, Bajaj Finance, Infosys, HCL Tech. So all these IT names are under pressure. Of course, Infosys will be reporting its numbers on the 18th, that is on Thursday. Of course, we'll be watching out for the guidance. So TCS, Infosys, HCL Tech among the top laggards, and NTPC, Bajaj Finance, Kotak Bank, Axis Bank among the other losers. On the gaining front, let's see, Nestle, that's the top gainer, almost a percent uptick coming in there. Titan, Bharti Airtel, SBI Life, Eicher Motors, Tata Steel, M&M, Hindalco. So mixed data coming out of China, but we've seen metal stocks reacting to that. So you have Tata Steel, Hindalco, from the metal pack. These are the stocks that are among the gainers today, because China's first quarter GDP came in way above estimates. Estimates were at some around 4.8%, and the figure is at 5.3%. So all in all, of course, that's the texture of the market. Weak open, 22,150. We are holding on to that mark as of now, but it's a triple-digit cut on the index. Although the Nifty mid-cap index is almost, on the threshold of turning into the green. But looking at the open, what would you really be watching out for on the Nifty metal pack now, Amar?
Yeah, so if you look at the Nifty metals pack, the metal stocks have been really outperforming, because despite the market correction, we have not seen some significant sell-off happening in the metal space. And if you look at the key names like Tata Steel has recently had made a high of almost 169, 170, currently it's around 162 odd level. So that clearly tells me that metals, it's definitely on the positive side. And if you look at SAIL for the matter, SAIL is also very close to its record highs, because it had made a high of almost 157, currently it's around 151, 152 odd levels. And if you look at the non-ferrous metals, so in that case, look at Vedanta. Again, Vedanta is not correcting. It continues to be very strong. So it clearly tells me that the Chinese data definitely has helped, and also the strong US data in terms of the US economic data, that also has been positive. So that tells me that these factors are definitely supporting the metals pack. But at the current levels, one needs to be slightly cautious at entering at the current levels, because the risk-reward ratio might not be that favorable. But the trend remains positive. Those who are long, they can hold their positions, or maybe they can look at booking part profits at the current levels.
All right, that's the view on the metal pack. But hold that thought, Amar. We'll come back and discuss specific stocks, as well as take up our viewer queries as well this morning. But let me also bring on board our fundamental guest for today. Joining me is Sandip Agarwal, who's a fund manager at Sowilo Investment Managers. Great to have you on the show, Sandeep. Of course, the global landscape has turned extremely volatile. You have Israel talking about retaliation, although global powers are saying that they will be staying away from that. But of course, we've seen foreign outflows and for the month of April, FI flows, have turned negative, right? So here on, would you say that any comeback from the FIs will only happen after the June 4 event, which is the result of the general elections? Do you think only after that we'll see some bit of a return of FIs, or do you think due to risk aversion we won't see FI flows coming back for quite some time going forward?
Yes, yeah. Good morning and thanks for having me on the show. As you rightly mentioned that, whenever there is a event, domestic event and or event like elections, even if the outcomes and the predictions are on the side where investors expect, still, they always want to hedge their positions, or they want to take a big position only after the event, even if it means that they have to get in after 5-7% jump from the current prices. They are generally okay, because see, these are all policy driven things, and broadly, all these large financial institutions and investment firms, they work on policies which are framed for a longer period of time, and the policy documents are made in such a way that all these short-term gains they avoid, but they make policies from a larger frame of things, larger scheme of things. So I think, as you rightly mentioned, they are all sitting on the fence and they are waiting for the election outcome. They are looking for a stable government, whatever it is. But once they see stable government, I think you will see a lot of money will come into India. I think there is no other country in the world which can offer all the things in one go, where political stability, growth, good control of the central bank, currency, everything comes together. So these are rare opportunity, and I think we are having our golden period.
All right. I want to get your thoughts on one point that I want to make. Notwithstanding yesterday's correction, when the advance decline ratio was somewhere around 1:5, data for April is showing that market momentum may be touching a new high. For April 1 to 12, this period, the advance decline ratio was at 1.5. Which is the best for BSE listed companies since June 2020. Would you say that momentum is now making a comeback, and that too in a big way?
Yes. So, if you see the data which has been published by various brokerage houses on the mutual fund side also, we clearly see a trend towards, a shift towards large cap, which has happened in the month of March. And again, I think in month of April, large cap and large size mid cap. So basically the mid caps which have become a bigger size, there is a lot of interest in those names. So I think, domestic funds and large investors are making their position in a way where they want to, play the big theme of infrastructure and other things. And also, surprisingly, another positive aspect is, if you see the manifesto which has been published by the ruling party, it has put a lot of emphasis on infra and digitalization and water and all those things. So I think those things are also the one where I believe that a lot of investment has started coming in, and probably investors will put more and more money there. So I think, as you rightly mentioned, the ratios are going to improve, and there will be short term these things which are global events, not in control of anyone, and they do hit the commodity and the crude, which is generally seen to be negative from our economic perspective. So because of that, broader index might be red or might show some panic for some point of time, but I think broadly the direction should be upward only.
All right, given the global turbulence, which are the pockets that you will be wary of at the current juncture, something that you would completely avoid in the current scenario?
So I think, if really, this escalation happens, as some of the media and some of the experts are predicting, that you never know, in war there is generally no control, or things may start small and then they take an ugly turn. If those kind of things happen, then obviously, there will be impact on crude prices, and if there is an impact on crude prices, then the interest rate sensitive segments can see some bit of challenge, and also some of the sectors which have raw material as crude, those can also see some challenge. So to that extent, we would be little cautious on the interest rate sensitive sector, primarily the banking and the NBFC sectors for the time being till stability comes.
The latest round of stress test results has showed that there's been an easing in stress for small cap schemes, but the latest AMFI data shows that the small cap funds did see an outflow for the first time in 30 months. So do you think here on the investors will shift focus to large cap funds, the safety of large cap funds, so to say, even though the latest stress test results are showing that there could be some bit of easing of pressure for small cap schemes?
So, in the month of March, February and March, where, our regulator has highlighted that there is some risk and froth in the small and mid cap space. At that time, I think there was many of the investors have taken a relook at the stocks, and wherever they thought that the hope story or the story is bigger than the fundamentals, I think there has been some trimming and rationalization which has happened, and which is good for the markets. But another interesting, I saw one report from one of the brokerage house. I am not able to recall where they have showed clearly that the way the small cap and mid caps have moved up in last 2 years is in line with the earnings momentum which has happened also. So now the price earning multiple for the companies as such has not gone up. Obviously, it looks more heated and has outperformed the broader index, but the earnings have also the earnings of mid and small cap has also outperformed substantially the large cap. So in my view, the good quality mid caps and where there is fundamental return growth and everything, I think those stocks will continue to do well. There could be temporary lack of interest or cautiousness, but once people again redo the maths and see the numbers, and when the delivery happens, I think again there will be a lot of interest which will come back in the small and mid cap space.
Let's talk about specific sectors then. IMD has predicted an above normal monsoon, season for the current year, right? And we've already seen a time-wise correction take place in FMCG stocks. Given the kind of prediction that has come out of IMD, do you think this is the right time to nibble into FMCG stocks?
So, absolutely the data is very encouraging. The rainfall, the average rainfall prediction itself is very positive, because we still have a large population which is in the agrarian society. So, the disposable income which goes into their hands goes up substantially if the rains are good and the monsoon is decent. So, obviously, all these FMCG names should do well. But, within the FMCG also we have to look at which are the names where the time corrections have been sharp, or where they are looking more rational in terms of price. I think those are the ones where the focus should be. So although we run a PMS and we have positions for our client and ourselves, so it is very hard to comment. But I think the likes of Dabur and the likes of Imami and the likes of HUL, they have gone through good correction, time correction at least, and that those are the spaces where there could be something which could be lapped up. So that is the way I would put. Or you can, also play the second derivative. For example, if the disposable income goes up, then the two-wheeler segment and the entry-level four-wheeler segment also could be looked at. The tractor space could be looked at. The housing, the building material space, the cement space, all this could be looked at, because when the disposable income goes up, the people would like to have more spent on for their own houses, and also spend on the two-wheelers and four-wheelers which they would be planning to buy. So I think those are the spaces which should do well.
Okay, what about the cables and wires segment? I was reading a recent report, I think it was a Motilal Oswal report, if I recall it correctly, on names like Polycab, RR Cable and the likes. But do you think premium valuations are justified for, for something like a Polycab?
So it is very difficult to comment on a specific name, because when the investors, large FIs and other investors come, they have limited choice, because they have other parameters as well, like liquidity of the stock and the daily volume and many things, and because of that they end up buying something which is at premium, and they also have more comfort because of long history and all. But let me put it this way, that the power sector as a whole and the derivatives of the power and the ancillaries in the power space are going to do phenomenally well over next 3 to 5 years. And in that space, if you see what all are there, there is cable, there is rectifiers, there is transformer, there is oil which goes into the transformer, there are plates which goes into the transformer, there is the copper wire which goes into the transformer. So all these spaces, should do well. So in the cable space and wire space also, it is very important for people to do more deep dive and find which are the names which are fairly valued, and they are also going to be natural beneficiary of this big growth which is going to come. And while RR and Polycab, these are all very good companies with very good history, but if someone does little bit more work, they will be able to find names which have deep value within this space also, and they will also be big beneficiary.
Want to get your thoughts on the telecom space as well. Of course, Vodafone Idea's FPO will be opening on Thursday, right? But do you think the 18,000 crore rupee FPO can revive fortunes for the telco major? And it has already outlined plans to roll out 5G within 6 to 9 months of this fundraise. Going forward, do you think Vodafone Idea will be able to sustain?
So, very interestingly, two sectors which has not made money in India for a long time, they have now a complete change in metrics. For example, if you see telecom and airlines, there were multiple players and there was deep cutthroat competition, regulation, capex. These are, both the industry, if you see, they have similar trades. They need lot of capex. They have cutthroat competition, pricing pressure, some bit of, they are regulated as well. From the government perspective. So all these things have led to massive underperformance for both these sectors for a long time. But in this when these tough times have happened, only 2-3 players have survived in each of the space. And I think going forward, this is a duopoly or monopolistic kind of situation where it will be now the pressure at least on the pricing side and all will ease off substantially. Large part of capex is behind. Now the capex which is also required is incremental. So I think these two sectors will do phenomenally well going forward, and within these two sectors, obviously from a market leader perspective, Indigo is a market leader, and on this other side you have Reliance and Bharti which are market leaders. So those looks very good. But obviously, when the sector does well, then the beaten down players also get a very good chance of revival. And 18,000 crore is a very big fund, and I think the banks will also match a debt portion for that equity. And when that kind of funding is available and the demand environment is strong, economy is doing well, and there is some bit of pricing power which comes back to the sector, I think companies can do really well and they can really turn around. So I think the main thesis is that competition and the weak players are out of the system. So now only 2-3 strong players are there. So I think there is a good chance of doing well.
But you mentioned airlines in this answer, right? So I just want to understand from the overarching theme of tourism, anything that's looking attractive, given the fact that of course there is more push towards domestic tourism, and with what's happening in West Asia, domestic tourism will once again get a boost, right? So here on any particular themes within the overarching tourism theme?
So, in India, tourism has a lot of catalysts which has suddenly come up. There is a lot of tailwinds which has all come together, and it has made difficult for many people to even travel and go for holidays. So, but if you see, there are 3 things. One is that, as you rightly mentioned, there has been disturbance for last 2.5 years in the whole in Middle East and some parts of Asia, and because of that, domestic tourism has picked up. Secondly, the Prime Minister himself have been pushing domestic tourism very aggressively, and there is a big fan following, and people do get influenced because he is a very good influencer. So that is another thing which is playing for domestic tourism. And third, religious tourism has become a very big catalyst for the growth of domestic hotel industry, the hospitality industry. I was listening to one of the conference in which Oyo Room's CEO was answering that they are having maximum demand for religious requirements in the city of Varanasi and Ayodhya and all. So I think that is another thing which is adding up. So I think in India, hotels and airlines are going to do extremely well, and even railways. And it is a big theme, and it is a structural theme. Only thing is that the capacity to build these are gestation period in hotel industry is very long, and similarly airline also, after you order you start getting delivery there is a lag. So all these 2 things has resulted into very high demand supply mismatch, and because of that pricings are becoming very high in both the industry, and because of that there is some discouragement in tourists and customers are postponing their travel and all those things. But I think overall, from a thematic perspective, both hotel and airline look very good. The power segment looks very good. The telecom looks very good. Infra looks very good. So we have more sectors which are looking good than sectors which are concerned. Let me put it that way.
Right. Last question, really. What are you making of the data that is coming out of China? This morning we had the Q1 GDP figure coming out. Of course, that was above expectations, but retail sales as well as IIP, kind of missed estimates. But of course, we've seen a good rally come in the metal shares as well, right? Today as well we saw a negative open, but we've managed to come back from lows, and in fact the metal index is trading in the green right now. Do you think this rally is sustainable, given the fact that metals are pretty much trigger happy, right? Whatever data comes out of China, we tend to react to that very quickly. So would you be cautious on the metal pack, or would you say that this leg of the rally would be sustainable and and investors could look at accumulating metal names now?
So say metals is a commodity, as you rightly mentioned. The cycles are quite volatile and very short-lived. So from that perspective, it is obviously a risky bet. But let me put it this way, that in the worst case scenario, also US will recover from the economic perspective from here on. Once rate cut cycle starts in, then there will be a big kick in demand from the US economy side, number one. Number two, even if you see China, for example, they are doing everything possible to revive their economy. So they are also, the government, the Chinese government, and is very much focused to revive growth. Obviously, they have some other priorities also, but their main priority is to revive growth, and the best way to do that is to give some booster to the real estate, which is one of the biggest consumers of the metals. So in my view, going forward, we will for metal sector, I see that there are more tailwinds than headwinds, and while volatility is synonymous with this sector, but I still believe that there is a lot of money which could be made in this sector, but the investor has to time their entry and exit and have to be very watchful, because this sector is the prices are very volatile, and the stocks move much faster than the prices of the metals. So given that disclaimer, I think we are definitely going to see more demand on the metal side also, and this stock should do well.
All right, that's on the metal space. But with that, Sandeep, thanks a lot for taking out time and joining in this morning and sharing your insights with us. Always a pleasure.
Thank you.
With that, let's quickly go back to Aamar, who's been waiting by on the sidelines. Thanks a lot for waiting, Aamar. Let's take up the viewer queries that are trickling in this morning. The first one is coming in on an HUL. Of course, LIC has hiked stake in the counter from 4.99% to 5.01%. Of course, the stock has managed to come back from the day's low, in fact, opening low, so to say. 2191 is where it's at. In the last 5 sessions, we've seen, of course, we've seen a time-wise correction in FMCG names, HUL, Britannia and the likes. But on the charts now, is there more weakness coming out of, the kind of trends that we have seen? Or do you think we could see some bit of buying now that we've had a positive forecast from IMD as well, and, LIC hiking stake as well?
No, I would say if you look at HUL, so clearly this stock has been an underperformer and has really disappointed the investors, just like HDFC Bank has over the last many quarters. Having said that, if I look at the charts from a long-term perspective, they clearly show that the stock is moving in oversold territory. So there is a possibility of a bounce back if you ask me at the levels. So anywhere between 2100, 2200, so the current level, these are levels where the stock is likely to find very strong support. And there could be a temporary respite or a bounce back. So those who are looking at entering this stock, ideally these are the levels where one can start looking at, because 2100, 2200, that's a key zone of a support zone, very strong support zone. And also what we are witnessing for the last few trading sessions, despite the sharp correction which the stock has witnessed from 2276 levels on 10th of April till 2172 as of today. So there has been significant volume and delivery quantity over the last 3 days compared to the average over the last 8 to 10 trading sessions. So that means that some buying interest definitely has come into the stock at these lower levels. So those looking at entering the stock, they can, but they need to understand that the stock is not in an uptrend, it's in a downtrend. It's around major support zones, so a pullback is expected. The levels to watch out for on the upside if the stock manages to start trade above the 2300 level is somewhere around 2400, 2450 would be the level where the stock would run into some stiff resistance. So it's more of a trading play between 2100 and 2500.
All right, this query was from Jeet. Hope that answers your query. But we also have a query on ITC from Yagnesh. He holds ITC, at 413 rupees a piece, and he wants to know the view for the near term, or in fact even 2 years, and long term as well, 10 years plus. What would you advise him to do?
See, if you look at ITC is one stock, if you look at it from a very long-term perspective. So the stock, what it does is that it gives returns, but then again it consolidates. Because if we look at the stock from a 10-year perspective, so the stock moved up substantially and then it went in for consolidation. Then again, it broke out of the consolidation where the resistance was somewhere around the 200, 250 zone. Currently, it's around 425, 26. So if you're looking at, you have to understand two things, whether you're trading or whether you're investing. So if from an investing perspective, whenever you're investing in any stock or a portfolio of stocks, you should look at only quality stocks and you should look at it in an SIP mode. So it could be a monthly or a quarterly, that really doesn't matter much. Having said that, if you're looking at it from a trading perspective, then I would say that the stock has immediate resistance coming around the 433, 440 zone on the short, on the downside. The stock has got support coming at around the 415 zone. So below 415, the stock has support. Towards 435, 440, the stock has resistance. So if you are trading from a short-term perspective, maybe you can look at booking profits anywhere between 430 and 440. Because till the time it doesn't sustain above 440, the stock could consolidate between 410 and 440. Hope that answers your query.
All right, that's the view on ITC. Hope that answers your query. Want to get in a query on HEG. Of course, this stock has had a phenomenal run in the last 5 sessions itself. It has locked in a 15% kind of a gain. Would you advise booking profits here?
So if you look at HEG, the stock has significantly rallied. I wouldn't say that one should look at booking profits because on the charts, the stock has broken key zone of resistance. Only one level that needs to be breached, because if we go back in time, the stock in December, the stock in 2018 had made a high of almost 5,000 levels. So it had made a high of 4955 in 2018. And currently it's almost half of that. So what you need to watch out for is one level, that is 2600, 2650. That's a key zone. That's almost 200 points from the current levels. But the way the stock has rallied, the way volume has picked up in the stock, I would recommend that you should hold your stock. If the stock manages to sustain above the 2600, 2650 rally, that means the stock could witness some really sharp up move. So rather hold on to your position. If you ask about what are the levels where the stock has got very strong support on the downside, so that level is somewhere around the 2150, 2200 level. So that's a level to watch out for. Overall, the trend for the stock remains very strong and firm.
All right, the uptrend remains strong on HEG. Just a couple of more queries, want to squeeze in quickly. Rakesh wants to know your thoughts on a VIPRO. He has 100 shares which he bought at 481 rupees a piece. He wants to know whether he should exit or wait for some bit of a rebound. What would you advise him to do?
I would say that you should rather wait for some exit, because the stock is very is close to very crucial support zone, which is around 450 odd levels. Or if you ask about some major support, so 440, 450 is a major support zone for the stock. So you can, if you want to hold, you can hold below with a stop loss below 440. But if you look at the trend for the stock is not really in an uptrend from a short-term, intermediate-term perspective. So what it effectively means is that on the upside, 480 is a zone of resistance for the stock, because if the stock manages to sustain above 480, then you would expect some rally towards 490, 500 odd levels. So it's more of a higher levels will be sold into. The levels are important, so we could expect some bounce back. So exiting the stock at anywhere between 480, 490 would be a good idea. Only sustaining above 500, then you can expect some significant rally in the stock, which currently is not displaying as of now. So we'll have to watch out how the IT companies, other companies report the results and what is the trend or expectations of investors with regard to VIPRO.
Right. One last query. This is the last one. Hinduja Global. Maheshwar Bhanu K wants to know your thoughts on this particular stock for the medium as well as long term. Is it worth holding the stock for a 1200 rupee target? What would you say?
See the stock, if you look at it from a yearly perspective, in 2022, the stock had made a high of almost 2000 levels, so almost 1960, and then it has currently trading almost less than half of that, 840. If you ask me the trend for the stock from a long-term perspective, that continues to remain negative. On the monthly charts, weekly charts, we are seeing some sort of pullback in the stock, but again, that's a shorting opportunity. So what it effectively means is that the stock has the recent low of 718, that should act as a very strong support zone. So that is very unlikely to be breached unless we see a major sell-off happening in the stock or overall the broader sense of the market. So that's a level where the stock has got good support. Again, on the upside, the stock needs to rally above the 1000, 1050 mark. Then only you can expect some significant rally. But the long-term trend, since the long-term trend is negative and the long-term trend changes slowly, it doesn't change that fast. So that really tells me that the stock is in for consolidation. So 700 and 1000, that's a range for watch out for. Lower levels you can buy below stop loss below 700. high levels, you should look at booking profits. Only about 1,000, 1,050, you can expect some significant rally in the stock.
All right, that's the view on Hinduja Global. With that, we've come to the end of this edition of Opening Bell. Thanks a lot, Aamar, for taking out time and joining in this morning and sharing your thoughts with us. But
Thank
of
you.
course, the markets, have gained ground. In fact, we are off opening lows near that 22,200 mark. In fact, the advanced decline ratio has, in fact, the breadth is tilted in favor of gainers now. 3:1. That's the advanced decline ratio. So breadth has clearly improved from what we saw at the market open, but right now, of course, the mid cap index has also managed to come back into the green. But with that, completely timed out. Thanks a lot for tuning in. Stay tuned for all your other news and updates.